We just celebrated U.S. Independence Day, so let's talk about central bank independence. The Fed just celebrated its 100th birthday. It was set up to be a lender of last resort during financial panics. Over time, Congress gave it three mandates: maximum employment, price stability, and moderate long-term interest rates. Now, you might be scratching your head and saying, I thought there were only two, but here's why. The Fed considers stable prices and moderate long-term interest rates to go hand in hand, so they count these two mandates as one. We're going to tell you why the Fed is dead wrong about all of this on Monday. But today we're turning to Austin Petersen, who is chief executive of Stonegait, LLC, and editor of thelibertarianrepublic.com. And we're going to talk about the jobs report and bubbles, specifically how the Fed both creates then deflates them. Austin, thank you so much for joining me.
Thanks for having me on.
Let's talk about these jobs numbers today. I have a couple of quotes I want to read. These are two headlines, and then we're going to compare them and see what's going on. So the first one is, economists react good enough for the Fed to pull back. And then the second one is, economy adds 195,000 jobs, but experts say the Fed should not curb stimulus yet. How do we reconcile this?
Well, the problem is the markets are way too dependent on what the Federal Reserve's actions are. I mean, if you look at the unemployment numbers, when the unemployment numbers went down a bit and we added more jobs, the market was reacting naturally, and all of a sudden the stock market boomed. But last month, when Ben Bernanke hinted that he might be pulling back this $85 billion in bond purchases, then all of a sudden the market was crashing. So what's happening is that the central banking chair is artificially creating all of these asset bubbles, and the markets are reacting negatively to this. So I think the problem is not natural market activity, it's the unnatural market activity of the Fed.
And do you think he's going to have to talk these markets back up again, given the situation he's in?
Well, I don't think he should, because unfortunately, I don't think
should or is.
Well, yeah, well, he probably will. I mean, he probably made a mistake when he said that he might be pulling back the $85 billion in bond purchases, but Wall Street seems as if they're way too dependent on what the Federal Reserve Chair says, rather than what the economy actually does. And if you look at the unemployment, we have long-term unemployment, people who have been long-term unemployed.
They're out of the statistics.
They're out of the statistics.
So the 7.6%, what is it?
Exactly. And marginally attached individuals are out of work, and they want to accept one, but they haven't even been looking for work for 4 weeks. Those people aren't counted. And then there are some people who have just given up completely. I think it's like something like 23 million people in the United States.
Yes. I mean, that gets into U6 and U3. I want to play something from Bernanke and get your reaction from it. So here it is, and it's a clip about him likening the economy to a car.
These large and growing holdings will continue to put downward pressure on longer-term interest rates. To use the analogy of driving an automobile, any slowing in the pace of purchases will be akin to letting up a bit on the gas pedal as the car picks up speed, not to beginning to apply the brakes.
Oh, this is the failure of central economic planning right there. This is Keynesianism laid bare.
Does he have a car? Can he drive it?
The economy is not a truck, okay? Austrian economists, when they teach about economics, they explain how the economy is organic. It's not like you just put gasoline in a car and then turn an engine on, and that's how it works. There are always organic bits and pieces to the economy that are fluctuating that no central banking chair could possibly imagine could come into the economy, could come into play. The problem here is that Ben Bernanke thinks that if you just put money into one end of the economy, that jobs come out the other end. You know, this is the failure of stimulus in Keynesian economics.
Certainly, and we saw in 2008, he was actually taking billions of dollars, hundreds of billions of dollars from one sector of the economy. He was blowing the money into the primary dealers and other emergency facilities, and then he realized that commodity prices were exploding, and then he had to pull it out of another. So he started actually selling T-bills during the summer of 2008, and I think that's something that some of the Austrian economists saw as a precipitating factor to the Lehman meltdown, when the short-term funding markets. I mean, we've seen a lot of bubbles in the last 10 years. Are they accelerating?
Yeah, you would say so, absolutely. If you take a look at China, for example, they've seen enormous growth in the last 3 decades, and now their central banks are starting to say, we need to start pulling back on this economic growth.
I think that's a major story.
It's ridiculous, too, because if you think about it, when an economy is naturally growing, why in the world would you ever want to slow it down? Only if you're centrally planning an economy and stimulating could you say, oh, we may be making some mistakes, we may have overinflated this sector, and then all of a sudden it could crash.
Sectors.
Exactly. And so the problem is that when you understand how markets work in a natural floating economy, when the assets start to increase, that's a good thing overall. No one would say necessarily that you might have, hyperactivity in the sector, that, there may be, irrational exuberance, as Alan Greenspan had said. They would say, no, this is natural growth. And you saw that in the Gilded Age in the United States, when we had a gold standard. We had, a natural monetary base that floated the interest rates rise and fall with unemployment. That's what you want to have. You want to have a natural economy that works in a way that's that's not artificial, because the Federal Reserve creates the boom and bust cycle you see here.
And can you explain that a little bit, how it actually does that?
Exactly. So what the Federal Reserve does is, if we have a problem with unemployment, they say, well, since this is part of our mandate, we want to keep inflation low, but we're going to go ahead and inflate right now a certain sector of the economy because we think this economy might be a growth industry. You saw this with the tech bubble in the 2000s. You saw this with the housing industry. So what the Fed is doing is it's picking winners and losers, and it's saying we know what economies should grow, and we're stimulating investment to that area. The Congress does this too by passing things like mortgage lending to people who are low income, and it stimulates the housing economy. But then what you've done is you've created this huge bubble. So the Fed stimulates that by stepping in and saying we're going to go ahead and offer very low interest rates, artificially low interest rates to these sectors, and it blows up the asset bubble and it creates malinvestment.
Yeah, and I think a lot of people need to understand that even before QE, the Fed was manipulating interest rates, and in order to do that, it had to print money. And it did that in 2005 and 2006 for an unnaturally long period of time, and that's what gave us the housing boom. So, I mean, what do you think the implications are of quantitative easing? What's different about this than the system that we had before? Well,
I was reading this morning, Moody's chief economist, Mark Zandi, was saying that the jobs markets really remained unchanged since the Fed has been stimulating the economy. They say we're growing at 175,000 jobs a month, but we've been doing that for 2 years. And that's where we started when we were at QE3. So we haven't really seen the Fed able to pull off their mandate, their end of the bargain, which is, keeping unemployment low, even when they started QE3. So I think the Fed is, if anything, they've had a deleterious effect on the economy, not overall.
And where do you think the Fed is going to go? They're jawboning about taking their foot off the brake pedal, but can they really do it? Are they going to have to reverse at some future point, even if they do?
Well, they absolutely will have to reverse at some point. I think Ben Bernanke does not want to reverse. I think that right now they're going to have to hedge their bets. They're going to keep inflation as low as they can while they try and keep the stimulus programs going that they have right now. I expect the Federal Reserve to sit on interest rates as they are right now, but in the future we're going to have to see a Paul Volcker style policy. We're going to have to see a rise of interest rates. Why in the world do we have these central economic planners telling us exactly how much we can make interest-wise on our money market accounts? You're cheating the people who are saving money, and you're bailing out Wall Street with these interest rates. It's just absolutely ludicrous. This is the economics of disaster, and it's really sowing the seeds for another financial crisis such as the one that we had in 2008.
Which could be worse, potentially.
Absolutely.
I mean, because we have $1.7 trillion in excess reserve. This is a topic we like to cover. Can Bernanke keep all that money, quote unquote, at the Fed, out of the economy when interest rates rise?
I'm not sure. If the interest rate starts to rise, and I do expect that we will see some inflation, and the CPI numbers that we're looking at right now, they're going to have to come out and say, hey, listen.
If you even believe them.
Right, exactly. We're going to have to start including some of the necessities, the commodities that people actually purchase on a daily basis.
Like food and
gas,
all that good stuff.
Yeah, exactly.
Okay, so the future of the Fed, can you lay out where we're going to be maybe in a few years? Is it possible that we might end up with a nationalized banking system, specifically a central reserve system that's actually controlled by Congress?
I would hope not. Good Lord. I know that
would be worse?
No, well, I do believe so. The Congress, who wants Nancy Pelosi running monetary policy? Really? I think that the best way to go forward is to move towards a decentralized monetary policy. We used to have a monetary policy that was set by state-run regional banks. Right now we have a central authority that says that, united we stand, divided we fall, basically, that if California inflates, if California's economy is doing bad and we have to bail out the region of California, then everybody sort of has to suffer for that. But in a decentralized economy, a more free banking system, as the Austrians talk about, if one region decided to blow all of their money on schools, public education, and it didn't work out for them, then they would have to suffer the consequences of that.
Well, this is interesting. So would we have 50 central banks, or how would this decentralized monetary system work?
Well, basically anyone could start up their own bank, print their own currency, and you have voluntary transactions. I would like to see the Federal Reserve ended, but not by force, but through competition to the marketplace.
Yeah.
And what we would do, basically, is abolish laws of legal tender. So when you pull out your dollar, it says this bill is legal tender. That's by law, basically saying you are forced to accept this. And I think in a free society or in a laissez-faire economy where you want real growth, stable prices, then you want to have a decentralized currency so that no one bank can say, well, we're going to force you to put up with these inflation numbers.
So, okay, let's say we get rid of legal tender laws. I mean, how are people going to pay their taxes? We still have a government infrastructure that has a lot of control over the economy.
Absolutely. Well, if you start by abolishing laws of legal tender, what you do is you're legalizing competition. So, for example, there was a man who created a Liberty dollar, and he was a private mint, and people were exchanging gold and silver coins. This man was called an economic terrorist and put in prison for voluntarily trading gold and silver coins that he had made himself. itself. So what would happen is that some people may invest in Bitcoins, some people may invest in Liberty dollars.
Maybe we'll end up paying taxes in Bitcoins. Austin, thank you so much for joining me. This has been Austin Petersen.
Thank you very much.
Well, up next, stick around because